A company can make millions in sales and still have nothing left over. Revenue is what flows in, but a business also pays suppliers, employees, lenders, and the government. Net income is what survives all of that. Welcome to Season 2 of MoneyMind. This season, we're covering profit-making and financial institutions. And we're starting with the number every business gets measured by: net income. Net income is a company's total revenue minus all its expenses, costs, and taxes. Every dollar earned, minus every obligation met. What's left is net income. Positive means the business made a profit. Negative means it ran at a loss. Which is why it's often called the bottom line, because on a financial statement, it sits at the very bottom of the page after every deduction has been taken. Picture a bakery. In a month, it sells $40,000 worth of bread and pastries. But it also spent $12,000 on ingredients, $15,000 on staff wages, $4,000 on rent and utilities, $2,000 on loan interest, and $3,000 in taxes. Total expenses, $36,000. Net income, $4,000. That's it. That's the profit the bakery actually keeps. Not the $40,000 it brought in, but the $4,000 left after every obligation was settled. Net income appears at the bottom of the income statement, one of the 3 core financial documents a company produces. Investors look at it to assess whether a company is profitable. Lenders use it to gauge whether a business can service its debt. And internally, management uses it to understand whether the business model is actually working, or quietly bleeding money behind strong revenue numbers. Revenue tells you what a business earned. Net income tells you what it kept. Those 2 numbers can look very different, and net income is always the one that tells the real story. Next episode, we're looking at a choice every company has to make when it spends money. Do you expense it now, or capitalize it over time? That's expensing versus capitalizing on MoneyMind. Subscribe so you don't miss it.